Hey guys, in this video, I'm going to go over how I made my first $10,000 in the stock market. So without further ado, let's get into the video. All right, so as I said, this is how I made my first $10,000 in the stock market. All right, this is what we're going to be covering. We're going to be talking about starting small and staying consistent. We're going to be talking about focusing on low-cost index funds and my approach. We're going to be talking about reinvesting dividends, all right? Very, very important topic. And then at the very end, I'm going to give you some very important tips. As always, I'm just some dude on YouTube. I'm not a financial advisor. All right, so starting small and staying consistent. This is probably one of the biggest keys that you could take away from this video. All right, I had to avoid the urge to time the market. I didn't try to predict market highs or market lows. I just kept investing knowing consistency was more important than perfect timing. All right, and this is what I mean. When I started investing, right, I knew one thing, that I was not a perfect investor. I was not the smartest investor. All right. However, I did know that I had one advantage, and that was that I could take advantage of market averages. Okay. So as you can see, let's just take the S&P 500 index as an example, right? It could be any stock, it could be any ETF, or it could be any index fund, right? But we have the average price, right? And I know this ETF, index fund, stock very well. And it didn't matter if the stock was going high or it was going low. I knew I was buying quality, right? I was always going to be buying quality. So I always did dollar cost averaging. Every paycheck I got, I was putting in $50 here, $50 here, 50, 50, 50 all the way through, right? Didn't matter if the price was high, didn't matter if the price was low. I was always putting in money into my investment portfolio. Now, whenever I saw huge dips, like you can see here, whenever I saw huge dips, that is when I would increase my cost averages, right? My dollar cost averaging. That's when I would start putting in $75, $100, $110, right? That's when I would start increasing those investment amounts because I wanted to take advantage of cheaper share prices. All right. So that is a key right there, is being able to identify when something has dropped substantially. You know it's a quality company or ETF, and you dump even more money than you normally would to take advantage of those cheaper discounted shares. All right, we call those fire sales. All right, I scheduled my investments. I set up a rule that for every pay period, I would put at least 20 to 30% of my money into investments. This kept me disciplined and removed the temptation to try something new. All right, I'm going to show you some graphs here. All right, and this is all real. This all happened to me. I don't have the actual buy and sell orders for some of them, but trust me, it was real. All right, so this is a crypto coin that I bought. Right, I bought somewhere towards the high, the 52-week high or whatever it is. And as you guys can see, it just never recovered, right? I bought somewhere here at the top and it never recovered. Pretty much took an entire loss on this coin. I invested into something called VeChain, and again, invested it somewhere near the top, and it just never recovered and pretty much lost all my money. And here we have the infamous GameStop. I think I put in like, again, $9,000 or $10,000, and I took pretty much a $7,000 loss, right? This is the buy and sell order, right? So huge, substantial loss on there. And I pretty much bought in because I had FOMO for all these items, right? I wanted to try something new. I thought I was getting the best, intel on these coins and on this stock. Turns out that I was totally wrong, and I paid the price for it. So I created a rule that I live by now. I only invest in simple, buy and hold, passive investments. I'm no longer investing in any of these sexy new startups, these sexy new coins, or whatever, momentum stocks or meme stocks or any of that stuff. I do not invest in anything I don't fully understand. And this is a rule I live by. All right. And I always put as much money as I can towards investing in things that I know about. All right. So I also focused on low cost index funds. All right. I chose index funds in the very beginning with minimum expense ratios, very small fees. All right. I chose index funds with low expense ratios, which helped me save on fees and allowed more of my money to stay invested. And this is what this is why I always harp on expense ratios and why they're so important when you're looking at these things, right? So VFIX, this was in my retirement account. So I was just dumping money because Vanguard is pretty legendary for having some of the cheapest cost index funds and ETFs and mutual funds available on the market. I also had VU for a short period of time, and I had FZROX when I was with Fidelity, and they have a 0% expense ratio there, right? So I was investing in these ones, but I want to show you the reason why it's so important to know the expense ratio on the ETFs you're thinking of buying, or even the mutual funds. All right, so let's say between both of these are all things equal, right? You put $10,000 into each of these, $6,000 a year. So that's $500 a month, I think. Both are going to return 8% over the lifetime. But you have an expense ratio of 0.03 and an expense ratio of 0.50, okay? And the investment horizon or investment years is 30 years. As you can see, over the life of the fund, on the cheaper one, the cheaper expense ratio, you're only going to pay about $4,500, right? And that's over the entire 30 years. Now, look at the other one, the more expensive one, you're looking at $72,000. All right, that's $72,000 that's going to some manager who didn't care whether the ETF or the mutual fund did good or whether it did bad. You know, they made their money off the fee that they charged you. And this is why this is so important. There's too many influencers out there, too many financial YouTubers out there peddling, you know, high cost ETFs, high yielding ETFs, you know, with expense ratios as high as 0.5 and up, right? But they never tell you that. And they never tell you the dangers of these holdings, right? They just say, look at the yield, look at the dividend yield. It's paying out monthly 10% yields, you know. But again, they're probably going to hold it for maybe 2-3 months and then sell out of it. And, you know, look at you, poor old you know, you have a ton of money in there and you just lost a ton of money. And now you're going to get stuck also with, you know, a high expense ratio. So again, look at the expense ratio. When I looked at it, that was one of the things that I kept in the back of my mind when I was choosing my index funds, and what helped me get to $10,000 much, much quicker. All right. I also looked for funds or ETFs that had broad market exposure. All right. This is why I always say the S&P 500 is probably the best thing that new investors can go for. And as they get a little more advanced in their, you know, strategies or their education, then they can start looking at individual stocks or different types of strategies like dividend investing or REIT investing. All right. But I chose a index fund with broad exposure. All right. Something like an S&P 500 index, which holds, you know, 500 of the best U.S. companies out there. Okay. And some people will say, oh, well, you should have international stocks as well. Well, the beauty of these 500 companies is that they are international. You know, you have Amazon, that's international. You have Google, international. You have Facebook or Meta, that's international. You have Netflix, international, right? You have all these companies within the S&P 500 index that are international anyways. So that is broad market exposure, right? That is broad, super broad market exposure. So even if the index would drop, you know, 5 or 6% or even 10% on really bad days, I knew that the greater market, you know, these individual stocks are probably dropping 20 and 30% on the day. So anyways, what helped me get to $10,000 quicker was going with a broad market, you know, ETF, something like an S&P 500 index. You can always look at those other ones, you know, the ones I'm talking about. You know, you have QQQ, which tracks the NASDAQ 100. You also have VGT and FTech, which are technology-focused ETFs, all right, from Vanguard and Fidelity, respectively. All right, so reinvesting dividends. This also helped compound my wealth much quicker. All right, boosting my growth. Instead of cashing out of dividends, I reinvested them. Over time, this compounded my wealth and helped my portfolio grow faster, right? Much, much faster. So this is what it looks like if you don't reinvest your dividends, right? If you instead take your dividend out and go buy McDonald's and Burger King and, you know, probably buy something else with it, right? Not reinvesting your dividends could be the difference between $100,000 and $21,000. Let me explain. So let's pretend back in 1990, you know, I put in $10,000 into the stock market and never put another single dollar in this ETF at all. And I just let it ride for 20 years. In 20 years, if I didn't reinvest the dividend, I would only have a account balance of $126,000, right? $126,000. However, if I did reinvest those dividends, I would have an account value of $248,000, right? That is a huge difference. That is a $121,000 difference. Imagine if, you know, you were putting money in this whole time, right? The difference only grows larger. So always reinvest your dividends. That's what I did, and that's what helped compound my wealth much quicker, because I was able to, again, go back to dollar cost averaging. I was able to buy more shares either at cheaper discounts or, you know, fair market value, or maybe a little steeper of a price, right? But again, I was always consistently buying shares. All right, staying long-term focused, this also helped me. I never saw dividends as income, but as opportunities to grow my investments further for the long run. I covered this just previously. Quick shout out, if you are interested in my free Skool community, link down below in the description. I have a free masterclass in there. You can join in the discussion. You can ask questions. I read every single post. I'm going to be having future webinars exclusively for members in the community. Again, link down below in the description. All right, so important tips. You want to start early. All right. Time in the market is more valuable than timing the market. The earlier you start, the better and more time you have for your investments to grow. All right. So start early, start today, start tomorrow, just start. Focus on long-term goals. All right. That is the name of the game. Avoid the short-term, you know, market fluctuations. Keep your eyes on long-term wealth building. Patience is key to growing a solid portfolio. The saying that I live by, or the motto I live by, is short-term pain for long-term gain. All right, remember that. And then managing your risk. All right, spread your investment across different asset classes if you know, are unsure about things, right? If you want to feel a little more safer at night or while you sleep, spread your risk around. You know, you can buy stocks, you can buy bonds, real estate, international stocks, some commodities like gold and silver, or even a little bit of crypto if you really, really want to spread your risk. But don't be too diversified, you know, to the point where you're not really making any gains because you're spreading your money so thin, right? In the beginning, you kind of want to be a little focused. That's what I did. I was more focused on investing in just a few investments, you know, and then as those portfolios grew, you know, I was able to either take out money or use money for different things, or sell shares and buy different things, or save cash and then go buy real estate, right? So I hope this video was helpful for you guys. I hope you guys enjoyed it, got a lot of value. Let me know down below in the comments what you guys think, and I'll see you guys in the next video.